The next absolute valuation technique that we'll focus on discounts back free cash flows and is reading number 35 of the level 2 curriculum. Before we do the valuation, we will first try and understand and revise the definition of the free cash flow to firm and the free cash flow to equity. Now, the cash revenues minus the cash operating expenses will give us the cash flow from operations before adjusting for working capital. Once we adjust for working capital, this difference will be equal to cash flow from operations excluding interest expense. So the only thing we have to be careful about is that when we knock off cash operating expenses, we should not knock off interest expenses. From that, if we subtract the capital expenditures, also known as the fixed capital investment, we will reach our free cash flow to firm. Please note, free cash flow to firm is the cash available to all suppliers of capital, or you can say to both equity and debt. From this cash, I can repay my debt also, I can repay my equity also, I can pay interests, I can pay dividends, I can repay principal, I can return the entire cash back to the shareholders. So from the free cash flow, if I pay my interests to the bondholders and calculate the net borrowings, the net borrowings can be positive or negative. Positive meaning I've borrowed more, negative meaning I've repaid back. The free cash flow minus the interest plus the net borrowing will give us the free cash flow to equity. This is the cash flow available to equity holders that can be used for reinvestment, or it can be repaid back to the shareholder. Now please note that free cash flow to firm as a measure is agnostic of the capital structure. That is, how much debt I take or how much equity I take in my company will make no difference to the free cash flow to firm. If two companies have both cash revenues of $100 and both have the same asset, so the asset is $100 in company A also, and the asset is $100 in company B also. However, A has funded it with 50% equity and 50% debt, and B has funded it entirely with equity. Then the free cash flow to equity may differ for these two companies, but the free cash flow to firm will exactly be the same as long as this asset exactly is the same. If the asset is the same, so it's the same plant, it's a cement plant, let's assume, in the same region with the same technology and the same sort of distribution and marketing network. If company A is able to make sales of 100, company B will also be able to make sales of 100. The expenses of the plant, that is operations, the raw materials, repairs, etc., electricity, power, will be the same for both plants. The plant doesn't care whether you've taken debt or whether you've taken equity, it will still run just the same. So the expenses will be the same. The free cash flow to firm, assuming there's no working capital or fixed capital problems, will be the same for both A and B. However, the free cash flow to equity will be different because some part of these cash flows will be going to repay the interest and maybe even the principal. So the free cash flow to equity comes after the repayment of debt. Free cash flow to firm comes before any payments have been made to the debt holders. Hence, free cash flow to the firms is the same. It will be agnostic of the capital structure. How much debt you have makes no difference to the free cash flow to firm. If there were two plants and you were going to decide whether I should buy company A's factory or I should buy company B's factory, you are going and only buying the factory. You don't care about the company and the structure. Then which cash flow should you look at? Free cash flow to firm or free cash flow to equity? if I'm buying the asset, I will pay for this asset and I will pay this company for the asset. The company can repay its debt, the company can repay its equity, the company can buy something else with it. I don't care. If I'm just buying the asset or just buying the factory, I don't care about how much debt he has taken because I'm not assuming his liabilities. I'm just going to buy the asset and pay for the asset. If I was buying the equity, then I would be concerned about how much debt there is. Because if I buy out the whole company or if I buy out all the equity, all assets are mine. But fortunately or unfortunately, all liabilities are also mine. So if I'm purchasing the equity, then I'll have to be careful that how much debt am I taking on and how will it be serviced and paid off. But if I'm buying just the asset or just the factory, then I need to see the free cash flow to firm. Free cash flow to firm tells us the value of the assets. Free cash flow to equity will tell us the value of the equity. The value of the equity can be depressed if there is too much debt. So if you are asked to compute the firm value is defined as the value of debt plus the value of equity. Then we will use the free cash flow to firm and discount it back at WACC. If you are asked to calculate the equity value, that is the market value of only the equity, buying equity means, or buying all of equity means you're assuming the assets as well as the liabilities. Then you will use the free cash flow to equity discounted back at the required return on equity. Equity value is the same as the firm value minus the market value of debt, or firm value is the same as equity value plus market value of debt. So why do we sometimes prefer free cash flow models over dividend discount models? Many firms pay no or even or low cash dividends. Dividends are paid at the discretion of the board of directors. It may be poorly aligned with the firm's long-run profitability. If a company is viewed as an acquisition target, then free cash flow is a more appropriate measure because the new owners will have discretion over the distribution of dividends. So like we discussed earlier, dividends are a minority shareholder's perspective. A majority shareholder can decide the dividends. So he's worried about the cash flows. Dividends are his choice. Free cash flows may be more related to the long-run profitability of the firm as compared to dividends. Hence, we sometimes prefer free cash flow models over dividend. Please recall, there are many formulae to calculate the free cash flow to firm. We studied at level 1. We will revise once again. So starting with net income, we will first add the non-cash charges, that is depreciation. We will then add back interest into 1 minus the tax rate because net income would have already had interest deducted. But if interest was deducted, we would have gotten some tax benefit also. So we can't write off or we can't write back all the interest. We will have to take away the tax benefit that interest was giving. So no interest means no tax benefit also. So interest into 1 minus tax will be added back, minus the working capital investment, minus the fixed capital investment. This will be the formula for FCFF starting with net income. Please try to write the formula of FCFF starting with cash flow from operations. So if we are already given the cash flow from operations, the only issue is even CFO already has interest deducted. So we'll have to add back interest, but if there's no interest, there's no tax benefit also. So interest into 1 minus tax. Working capital is already considered, non-cash charges are already considered in CFO. Only thing remaining is we need to deduct the fixed capital investment or the capital expenditures. So calculate the fixed capital investment with no long-term asset sales. So Merox Incorporated financial statement for 2009 include the following information. Gross property, plant and equipment has gone from $3,000 to $4,000, and the net property, plant and equipment has gone up from 2500 to 3000. There was no sale of PP&E during the year, and depreciation expense was calculate Marox's fixed capital investment for 2009. So it's pretty straightforward. The gross property, plant and equipment can go up only if we purchased new asset. So 3000 becoming 4000 means our fixed capital investment was equal to $1,000. Using the same information as in the previous example, but suppose that the company reports capex of $1,200 and long-term asset sales of $500 and depreciation expense of $200. The long-term assets sold were fully depreciated. Calculate the revised fixed capital investment for 2009. So if the capex is given and the asset sales are given, then the fixed capital investment would be the cash outflows minus the cash inflows, that is equal to $700. So we didn't really need any information from the previous example in this case because the capex was anyways given to us. Anson Ford is analyzing the financial statements of Sting's Delicatessen. He has the 2009 income statement and balance sheet as well as 2010 income statement, balance sheet and cash flow statement forecasts as shown. Assume there will be no sales of long-term assets in 2010. Calculate the forecasted free cash flow to firm and the free cash flow to equity for 2010. So for 2010, we are given the income statement, we are given the balance sheet, and we are given the cash flow statement. Please note, if the income statement and balance sheet is given, we don't really need the cash flow statement. We can forecast that on our own. So let's first try to calculate the free cash flow to firm, which will be calculated as the net income plus interest into 1 minus tax plus the non-cash charges minus the working capital investment minus the fixed capital investment. Net income is given to be $56 in 2010. Interest is given to be $15 and tax rate is given to be 30%. Non-cash charges, that is depreciation, is $50. So we just need the working capital investment and the fixed capital investment to compute the free cash flow to firm. Let's first try to compute the working capital investment. Remember, when calculating the working capital investment, do not include cash. Cash is the end result, so it is non-cash working capital. So accounts receivable has gone up by $15. So that's an investment of 15. It's minus 15 as far as cash flows, or an investment of 15. Inventory is another investment of 10, or a total investment in the current assets of 15 plus 10, that is $25. Accounts payable remain flat. Debt will not be a part of working capital. So the working capital investment is $25. There is no other item that impacts working capital investment. Similarly, let's try to calculate the fixed capital investment. The gross property, plant and equipment has gone up from $300 to $400, hence a fixed capital investment of $100. We can input the two values and compute our free cash flow to firm now, which will come out to be 56 plus 15 into 1 minus 0.3 plus 50 minus the working capital investment of 25 minus the fixed capital investment of 100, which will come out to be minus $8.5. The next part asks us to calculate the free cash flow to equity for 2010. So the free cash flow to equity can be estimated from the free cash flow to firm minus the interest into 1 minus the tax plus any net borrowing that we have done. Free cash flow to firm has been calculated as minus 8.5. Interest is an amount of $15, or 15 into 1 minus the tax rate would be 15 into 1 minus 0.3, plus any net borrowing that will again come from the balance sheet. So if you see the short-term debt, that has gone up by $10. The long-term debt has gone up by $14. So total investment or total increase in borrowings is $24. Plus $24 of net borrowings, which will give the free cash flow to equity as $5. So that is the difficult part of free cash flow valuation. Essentially, computing the free cash flow to firm and free cash flow to equity is where 90% of the question is going to lie. Once you've computed, the discounting is exactly the same as in the dividend discount model. So we forecast the free cash flow to firm, the free cash flow to equity, and discount it back to compute the value at t equal to 0.